Welcome back to The Possibility of Finance with your host, Boring Joe. As we continue on with our Investing Basics series, today we will be touching on multiple ways of categorizing a stock, and as a bonus, we will start to explore indexes. Without further ado, let's just jump into it. The first way to categorize a stock is by its size. At the very top, we have large cap stocks. While there are no set definitions by any government agency, a large cap stock usually has a market cap of over $10 billion. They're pretty stable and have been at around that market capitalization for a while. Traditionally, you think of something like Walmart when you think of this category. Next, we have mid-stock caps. This is the next level down in market capitalization. These are about $2 to $10 billion companies, usually pretty stable, but they still have quite a bit of room to grow at a respectable rate. For the final size category, we have small cap stocks. These are the babies of the market capitalization world, with less than $2 billion in market capitalization. These are still pretty large corporations compared to average Joe size, but not in terms of the global economy. These are the ones with the most growth potential, but also the ones with the most reasonable risk, according to traditional wisdom if you compare them to a penny stock. We will get into penny stocks at a later date. Next, we have growth and value stocks. Growth stocks are companies that are still actively in their growing phase. Usually this is benchmarked against the overall economy. To use an example of this, let us imagine that Boring Joe Inc. has a positive cash flow, which basically means that it's making more money than it's spent, and that flow is growing faster than the overall economy. Boring Joe Inc. can be considered a growth stock. This is the hare in this story. Value stocks can be summarized as the tortoise of the story. Slow and steady is our axiom. It's worth keeping in mind both approaches have their merits and their risks. Some stocks are being sold cheaply because there's an underlying problem with the company, hence they are not true value companies. Just because it's cheap does not make it a value company. Conversely, some growth stocks are unstable. You might end up holding the bag for a slowing business with no further growth prospects. Due diligence is always important when looking at stocks. The final category is domestic and foreign stocks. Domestic stocks are the stocks of American companies traded on the various exchanges found within the United States of America. Foreign stocks are the companies that are listed outside of the United States of America. These can be traded using something called an ADR, which stands for American Depository Receipts, which is a fancy way of saying shares in a foreign company. There are a lot of strings attached to ADRs, but that's a video for another day. And now for the most important part of this video, index funds. My personal favorite way of investing, Warren Buffett, the Oracle of Omaha's preferred investment strategy for the average Joe, and quite frankly, what should be the goal for most investors. See, when I started my financial journey over 10 years ago, it involved something most people have and really shouldn't be part of the equation when looking at your investments or personal finances. If you guessed I was talking about ego, you would be right. I, like many young investors, thought I could pick winning stocks every time, or at least enough times to be able to beat the returns of the S&P 500 or a total market index fund. This next part may surprise you, but no, it's extremely difficult to do. The individuals who can consistently beat the stock market at its own games are extremely rare. I'm not one of them. Odds are you're not one of them. Boring Joe will always tell it to you straight. But that brings us to the question of why would you? Yes, the possibility of larger returns should excite you. It should motivate you. But not if it's going to guide you down the path of throwing money into the stock market without consideration for risk management or having a diverse portfolio. That's how mistakes are made, and those mistakes could end up being very costly. It also involves an extraordinary amount of work. But alas, there is a solution. Take the ego out of the equation, and instead of exposing yourself to the whims of one single stock, buy an index fund. It's a basket of stocks wrapped into one convenient package. Index funds are mutual funds or ETFs offering you a broad selection of stocks, giving you market exposure, low operating expenses, risk mitigation, and a very diverse portfolio, all under one simple fund option. To give you an example, and please bear with me because this one's going to be a doozy, the S&P 500 is tracked in the Standard & Poor's Depository Receipt Standards & Poor's 500 ETF Trust, most commonly known as SPY. And thank you to whoever shortened it to SPY, because that was a mouthful. It took multiple attempts to record, and I don't ever want to have to repeat it again. Inside of this ETF are all of the companies found in the S&P 500 index. This provides the following advantages to you. A single purchase point to own the 500 largest corporations in the United States. You're still paid the collected dividends of all companies owned, which pay dividends. Risk mitigation, because unless the entire United States implodes or all 500 companies go bankrupt, the fund will protect you from single stock collapse. And finally, extremely low fees, as these funds are passively managed and they do not come with the high expense fees found in actively managed funds. Something to keep in mind is that while these funds have grown to encompass trillions of dollars in value collectively, nothing in the market is 100% risk-free. And I cannot stress enough that you must always do your due diligence on any investment vehicle. It is paramount for your financial success. And even though index investing can be a very passive method of investing, you should still keep an eye on your investments just to make sure that nothing crazy has happened in the absence of you actively managing them. If you liked this video, please give it a like, and if you really liked it, give it a subscribe. If you have any feedback or questions, please leave a comment. Thank you for watching, and see you next time.